Today's ETF matchup features funds linked to two indexes with two totally different personalities. The S&P 100, built for stability, while the Nasdaq 100 is built for speed. Today, we're breaking down how these ETFs stack up and which one might fit your strategy. Go nowhere. Welcome to ETF Battles. I'm DeLegge. This is the place where we congregate to analyze and judge your ETF matchups. Keep your excellent ETF battle requests coming. Send me your ticker symbols in the comments section below. We could do double, triple, and quadruple headers. And of course, join our community by hitting the subscribe button. Don't be a stranger. Check out the description section below. We've got links to our program sponsor Direction. Besides leveraged and inverse choices on broad market indexes, there's lots of choices to ETFs linked to industry sectors, along with Mag 7 and single stocks like NVIDIA, Palantir, Tesla, and many others. Hit the description section below to explore the entire lineup at direction.com. So today's ETF contest was requested by a viewer named Joey, and it's between OEF, which is linked to the S&P 100, versus the triple Qs, which follows the Nasdaq 100. Two very different strategies, as you're about to learn and find out. So which ETF offers the better approach? Well, for the answer, let's tap into the analytical prowess of two of the best in the business. We've got Athanasios Psarofagis, ETF analyst at Bloomberg Intelligence, and Tony Dong, founder at ETF Portfolio Blueprint. Gents, welcome back.
Thanks for having us, Ron.
Nice to be on.
So our four battle categories are cost, exposure, strategy, performance, and mystery. Mystery, I should remind you, is where our judges can choose any factor that they feel is crucial to today's contest. Our judges can also nominate wildcard ETFs, or they can opt for split decisions. It's completely up to them. I've got the scorekeeping chores, and at the end of the program, we'll declare an overall winner. Keep in mind, none of the battle outcomes that we ever do on this program are ever predetermined or known in advance by myself or our judges. Let's kick things off with the first category, cost. Tony, please get us started.
Yeah, so before QQQ converted from a unit investment trust to typical 40 Act ETF, it charged a 20 BIP expense ratio. And that's because Invesco could only be reimbursed for marketing expenses, but now they can actually charge a proper management fee. You've seen it now drop to 18 bips, which puts it a shade cheaper than OEF, which still charges 20 bips. Both ETFs have the same very narrow 30-day median bid-ask spread of 1 bip. So again, when you add them together, the triple Qs are still the cheaper one here. So my vote goes to QQQ.
Athan, you're up next. How do you see it when it comes to cost?
Yeah, that was great. I mean, honestly, OEF doesn't get talked enough about for a $28 billion fund. People forget about it, right? We go to the S&P or the Qs, but yeah, that was, again, they were the same. They were both at 20 basis points. You also have QQQM, which is like the mini version of the Qs, which is 15 bips. Now we're just slicing by basis points, obviously, but I think because it's so close, that's all we really have to go. They're both liquid, they're both large cap U.S. stocks. I think QQQ just gets the edge here. It's a little bit bigger, and just slightly cheaper. But even at 20 bips, that's not a big difference. But just slight edge here is going to go to the Qs.
Well, that takes us next to exposure strategy. And Tony, you're still up. So break it down for us. How do these two funds look when it comes to what they do?
Yeah, so they're pretty interchangeable if your strategy is just to go mega cap growth with a big focus on the tech sector. Both of them have a massive tech sector overweight at about 50% of the triple Qs, whereas for OEF, it's around the same. The main difference here is the triple Q's lack of financials, and that's just because of what the Nasdaq 100 index does. You take the largest 100 companies by market cap on the Nasdaq exchange, cut out the financials, and that's it. Whereas OEF is the top quintile of the S&P 500, so you don't lose financials. That's why OEF will have things like Berkshire Hathaway. It will have companies like JP Morgan Chase, and my favorites, which would be Visa and MasterCard. Even though a lot of these, have quasi-tech characteristics, growth traits, the Qs aren't going to have them. And that's just one of my biggest gripes with the Qs is just that arbitrary lack of financial exposure rule. And and one more thing I want to point out to listeners is that the triple Qs are not explicitly a growth or tech index. It's kind of a carryover from the early days of the Nasdaq, where they were very willing to have a lot of upcoming innovative tech issuers list. So Microsoft, Cisco, Amazon, right? And that's persisted today. And it's kind of built a reputation as the exchange to be if you're kind of in that industry and trying to raise capital. So to bring it back, the lack of financials part really irks me. I don't see any good reason to just blanket exclude a particular sector. So I like OEF better.
Thank you very much, Tony. Athan, you're up next. How do you see it when it comes to exposure strategy?
Yeah, that was really great. So I took all the good talking points, but I think the financials thing is such a big deal because, yes, with OEF, QQQ, you have 100 stocks. You're going to be tech heavy, whether you like it or not. But financials is the second largest sector. That's 12% of the fund that you're not getting through the Qs. So even though the Qs are it's been a stud, it really shouldn't work. Like Tony was saying, it's arbitrary. It's only Nasdaq listed stocks. It's no financials. Just like, for example, the New York Stock Exchange Composite Index is beating the Nasdaq Composite this year, right? So you have to just kind of think about it through that. Like, what if someone just made a NYSE 100? But over the long term, they kind of get you to the same spot. You're going to have a lot of tech, but I think if you're thinking that we're getting an environment that's not maybe as pro-growthy right now, and if you think you've seen things like equal weight S&P are doing better this year, this is where OEF I think is going to be a better choice. But either way, you're still going to be getting a lot of exposure to tech, so you're not really going to be able to avoid that. I think to a lot of the same points that Tony was making, they're both 100 companies, but you're getting a slightly better representation with OEF than you are with the Qs. It's, obviously you can always look back and say, well, yes, if you were overweight tech through the Qs, you would have, done really well. But don't be, you're also seeing switches, right? So just for example, it's not a tech company, but Walmart recently did an exchange switch, right? So you also have things like that that can impact these indexes. I just think OEF, just taking out whatever it's that arbitrary listing and things like this, you're going to get a much better, more representative basket. And for that reason, I think OEF is just a better constructed vehicle.
All right. Well, that takes us next to performance. And this is where our judges break it down for us. How does it look in terms of historical performance? But also, we also need to think about, going forward, right? Because we need to think about potential future returns. So, Athan, you're still up. Break it down for us. How do these two funds look in terms of performance?
So over like a 5-year period, they're kind of at the same spot. As you start to zoom out, the Qs really start to separate from everything else. But again, this is all hindsight. I'm going to throw a wild card in here, and I kind of alluded to it with like RSP, which is an equal weight fund. You're getting a little bit more broader exposure. You're getting all 500 names, but you're not necessarily you're still getting a good amount of tech. But if you kind of look at how we're positioned and even all the types of ETFs that are launching, we have a lot of tech exposure, whether you like it or not. And I think sometimes that can be a little bit worrisome. You kind of saw it a little bit this year. So I'm just going to throw in a wild card pick. I think RSP is a really interesting choice too. It's cheap, it's representative. You're getting, you have years like the beginning of this one that you have other names like industrials, energy. Like energy is the best performing sector this year, and this is one of the lowest weights in the S&P 500. But with equal weight, you're starting to pick up on a lot of this. So I just think that RSP, I think maybe for the environment that we're heading into, could be a more interesting choice.
Got it. Thank you, Athan. Tony, you're up next. How do you see it when it comes to performance?
Yeah, so I've got a pretty long back test here in front of me, stretching just over 25 years from October 27th, 2000 to March 6th, 2026. So it covers just the immediate aftermath of the dot-com bubble. The interesting note here is that versus OEF, you would have been like losing in the Qs up until an inflection point just around March 2020 COVID. And that's when that really took off. And a lot of that is, again, like the companies that choose to list on the Nasdaq. In addition, you would have avoided some of the drawdowns during the 2008 financial crisis because, well, you didn't have financials, and that worked out for you given what happened. So long term, yeah, over this period, the Qs did 9% annualized total return without taxes, whereas OEF liked it at 8.1%. But the Q drawdown was massive. So during the dot-com bubble, you would have been down 75.85%, whereas OEF only 54.12. So that concentration can help you or hurt you. It'll hurt you during dot-com situations. It'll help you during great financial crisis situations. You really got to pick your poison. But if we're just going to compare on raw returns, man, like the Qs have demolished, and Invesco knows it. That's one of their biggest selling points for this.
Yeah, great points. And also, we can also, depending on the time period we're looking at, have long periods of where if an investor bought at the wrong time, I mean, they had what, a 10, 15-year period?
13-year drawdown.
How
13
long
years
that?
for the Qs. 13 years, I'm looking at it. From 2000, for my period in 2000, you would not have broken even until August 2013 with the Qs, whereas OEF would have been slightly earlier in August 2012.
Yeah, great point. So timing plays a big role into this. Thank you for that additional detail, Tony. So now we shift to the mystery battle category, where our judges can give us a factor or piece of criterion that they think is crucial to today's contest. So, Tony, you're up. What is your mystery battle category, and which of these ETFs takes it for you?
It's a point of annoyance for me when someone's trying to look for mega cap exposure. Say, for instance, you just want cheap beta in your portfolio. It's fine. But what you're actually getting now, because of a lot of how these market cap weighted funds are, you get a style bias, and that's towards growth. And before you know it, the factor exposure in your portfolio can quickly spiral out of control. I actually prefer going active here, but thoughtfully. And my candidate, I've talked about it before, is the principal US mega cap ETF, USMC. So it's a much more concentrated fund of just around 25 holdings actively managed. But it's pretty much, you can think of it kind of like the top 25 holdings at the S&P 500, but actively managed, so the weights aren't too concentrated and top heavy, unlike OEF or the triple Qs. And it does lean growth still, just because of how the market is, but not so much as OEF and the triple Qs. And the other thing is that despite being actively managed, it's very affordable. I think it's like under 15 bips in fees. 24 holdings. The active share is not great. It's 53.54. You could make a case for closet indexing here, but again, like for an active strategy, it's very affordable. So if you were looking for mega cap concentration, this would be my pick.
All right. Well, that takes us next to Athan. Your mystery battle category, what is it, and which of these ETFs wins it?
One thing I think we can look at is just kind of valuations, whether you want to look at PE ratios or anything like that. With the Qs, they're going to be a little bit more expensive, meaning how many times they're trading off earnings right now, versus OEF. Again, because of the different sectors, because of financials, that's going to drag that number down. So it's a little bit cheaper from that perspective. So I'll give it to OEF. And the other thing is just even the market capping methodology. I know it sounds obvious, like these are both market cap weighted, but because we're taking all the stocks, right? You're not just looking at the ones listed on the Qs. Eventually, the all-stars are going to bubble up in OEF, right? So I like that you're still able to pick up some of the broad studs outside of just the Nasdaq, and eventually those weights will just bubble up. But I think just from a valuation perspective, and it's performing a little bit better this year, I'll give that advantage to OEF. Again, just going back to, I just think it's a better constructed portfolio.
All right. Well, we moved to the part of the program where our judges can give us their overall battle winner. How will this go down? Athan, give it to us.
At the end of the day, they're both going to be really cheap, and you're going to get exposure to just really great, innovative U.S. companies, right? That's not going to go away. Like timing of it, whether it's you have too much tech or it's too expensive, that will always kind of ebb and flow. But for the most part, you're still going to be getting really, really great U.S. companies in either one of these. I think just where we're going, and I sort of like being able to be spread out a little bit more. I'll give this to OEF. I don't think it's a surprise based on like everything I've been saying. That I just like that one, the way that one's set up. You're still getting plenty of tech, still getting all the names on the Nasdaq and all the names on the NYSE that can show up. So I think overall, I like OEF over the Qs.
Tony, your final chance to weigh in with your overall winner.
I concur. It's OEF for me. I'm going to say it here. There is no economic rationale for A, excluding any particular sector, and B, excluding companies based on what exchange they're listed on. There's no sense. I hear this argument sometimes where people say, well, the Nasdaq companies have historically reinvested high in their R&D. Okay, but like if you wanted to screen for high R&D investment, why don't you just do that directly with a filter as opposed to doing it in a roundabout way based on what exchange it is? It's a marketing gimmick, Oh, and also like high reinvestment in companies historically based on the fama French factor have led to underperformance. Like conservative companies do better. So keep that in mind the next time you see a hyperscaler announce $100 billion in capex. Bring it back to OEF versus the triple Qs. OEF all the way. Like people forget that before the S&P 500 was like really big, OEX futures were all the rage on Wall Street desks, right? OEF has a long history. It's been back since the 2000s. It's been tested through the dot-com bubble, and it held up way better than the Qs next time. We're seeing, Shiller Cape ratios close to the dot-com bubble. We're seeing the Buffett indicator 230%. Do you really want to be that much in tech? I prefer to be spread out among the sectors more. And while they're both concentrated and growth-focused, OEF is my pick here.
The baby influencers have no idea what you just said, Tony. None of them are. They're all a bunch of teenagers, it seems like.
They'll learn.
Well, our judges have spoken, and today's winner is OEF, and so many good reasons and arguments made. How about financials? You don't get that with the triple Qs. You do get that with OEF. A couple wildcard nominations, RSP, which I thought was interesting. That was from Athan. Giving some love to equal weighted S&P 500 investing. It's been a while since we've heard that, but these types of strategies have been making a move. And, that particular ETF RSP, dialing back that tech exposure with its strategy and also the top heavy mega cap weighting because of the fact that you're equal weighting each one of those 500 stocks. And then Tony with his wildcard choice, an active mega cap ETF, USMC. So be sure to check out that particular ETF. Very strong opinions on today's program, and that's the way I like it. What did you think, audience, of today's showdown between the triple Qs and OEF? Hit us up in the comment section below. I know that you've got some strong opinions and comments about today's episode. Athan and Tony, great job on today's program. Look forward to having you back very soon.
Likewise.
I'll be back anytime.
Hit me up with your ETF battle requests in the comment section below with your ETF ticker symbols. We could do double, triple, and quadruple headers. Also, a big thanks to Joey, our viewer for today's matchup. Well done, Joey. And again, I'm Ron DeLegge with ETF Guide. See you on the next episode of ETF Battles.